Welcome back. You're watching Squawk Box, live from the NASDAQ market site in Times Square.
Good morning. U.S. equity futures at this hour have turned positive, up 20 points or so on the Dow. The NASDAQ and the S&P will be trading at new highs again, I guess, based on where they closed yesterday. Nissan shares are tumbling 4% overnight in Japan. The company slashing its profit outlook to its lowest level in nearly a decade, citing expenses related to extending vehicle warranties in the United States. And the Japanese automaker says sales took a hit in the aftermath of the arrest of its former chairman, Carlos Ghosn. What's the latest? I was following it a little bit when I was out, but I just reading that they were going to come up with new indictments, but once they come up with the new indictments, you can make bail and get out of jail. So you're held until they decide what they're going to charge you with?
But
I decided I don't even want to stop by over there.
This is a new charge every time. The old one.
But it's a different system of justice.
Of justice, yeah. That's been the biggest highlight, I think.
Totally. It's been illuminating, right?
I don't know exactly what happened in this situation. We will continue to hear more. But, yeah, the idea of, like, being in an isolated jail cell where you don't even get lights are on 24 hours a day, and there's no even half hour that he's allowed out during the week. He doesn't even get that.
Not on weekends.
Not on weekends, yeah.
Amazing. Well, Nissan aside, solid quarterly results help lift markets to record highs. Let's get right to our roundtable this morning. Joining us for that is Stephanie Lang. She's Principal and Chief Investment Officer of Harmach Berg, and Michael Tyler, Chief Investment Officer at Eastern Bank Wealth Management, as well as our guest host this morning, Joe Terranova, Senior Managing Director at Virtus Investment Partners. And Joe, of course, also a CNBC contributor. Morning to everybody. So, Stephanie, interesting moment here. We could either say this market has gone up 25% past the old highs in 4 months, and seems like maybe it's getting overheated. On the other hand, it's gone almost nowhere in 15 months because January 2018 was just 2% below. So is this the top end of a trading range, or is it the start of something a little bigger?
You know, we're overall pretty bullish right now, and the reason is that data is telling us to be. If you look at the economic numbers, we're still very pleased with what we're seeing. Retail sales have been strong. The consumer has been healthy. Even though growth seems to be slowing when you look at leading economic indicators, overall, we don't think there's a recession in the near term. I do think the market's been worried about earnings, and we're actually quite positive in what we're seeing with earnings reports going on right now. If you look at some of the earnings revisions, we think the worst is behind us for now. We've actually seen 6 sectors actually revise their estimates higher since the end of March. So overall, we think that the environment's good. And if you look in the past at this kind of slow growth earnings environment, it's actually been a quite positive environment for stocks. Yeah. Last year, you would have thought with 20% earnings growth that the market would have been strong, but actually this kind of low growth and negative growth environment has been in the past the best for stocks.
Well, Michael, that kind of gets to a little bit of the talk about a sweet spot here. So if, as the market has been sort of suggesting, this is just a stutter step for earnings growth, and we have a Fed that arguably is now a little more dovish than the consumer economy maybe demands domestically, that's pretty much a good formula for equities in general. But I guess the question is, can that last right now if everybody now agrees that the economy maybe had its softest point so far?
Well, the economy probably did have its softest point, so that much I agree with Stephanie. But the challenge is what's coming ahead, and I think that there's still a sense that the Fed is a little bit twitchy, and maybe if the stock market roars ahead, they may try to sneak in a rate hike, and the market's not prepared for that. We're also looking at a presidential election campaign coming up in which healthcare is going to be a major topic, Medicare for all and all that stuff. That has weighed on healthcare stocks, and it will continue to. And I think that, well, let's face it, we have had negative earnings so far this quarter. You know, we're only 20-25% into it, so it's not meaningful yet. But there is some concern still that there's some volatility. There's some issues that we have to work through. I think that gives you the wall of worry that can let the markets end the year higher than they are right now. But we may have some bumps along the way.
So, Stephanie, the market clearly is a growth market. It seems as though momentum is back in favor. Is that the correct strategy for investors looking forward focusing on technology companies, focusing on companies that are showing that organic growth, and maybe staying clear of the value type names. Certainly, we're seeing small caps underperform relative to mega cap and large cap.
You know, one of our most interesting ideas are to have a higher beta play on the global economy. So we're looking at things in terms of what can benefit from a rebound in the global economy, because we actually think that we're poised for a second half recovery. Some of the areas that we like that are poised for that recovery are emerging markets and industrials. Industrial stocks actually have that higher growth that you're talking about. And we think in a low growth environment like this, areas of the market such as industrials and tech stocks will be rewarded. However, right now we're concerned about the valuation in tech stocks, though industrials are still trading at a discount to the market.
And Michael, you mentioned, I guess, the political overhang on healthcare. Does that present an opportunity, or does that say, you know, stay away for the next year and a half?
Well, it may be a tough slog for some of the companies. You've also got some big companies in big pharma land that are hitting patent cliff issues, like Bristol Myers. That's why they bought Celgene, for example. Or AbbVie has a big patent cliff issue coming up as well, where their internal pipelines aren't yet rich enough to offset revenue loss from drugs coming off patent. So healthcare is really a tricky issue right now, but we love the biotech sector. We think that a lot of those companies will get bought out as effectively outsourced R&D for big pharma. That's fine. So you can make money in just about every sector. You just have to think about where to look. Emerging markets is a fabulous place to invest right now for a lot of reasons, in terms of where the dollar is, in terms of their valuations, much cheaper than the U.S. Growth is looking very good there. So globally, there are definitely places to look. Within the U.S., there are definitely sectors that you can make good money, even if the overall market kind of just creeps higher and in fits and starts.
All right, creeping higher is what it's been doing the last several weeks at least. Michael, Stephanie, thanks very much. Appreciate your time this morning. And Joe, of course, sticking around for the rest of the show.
Yeah, like, you know, it's my job.
Both Joes.
Okay. All right, yeah.
When we come back, Boeing is set to report. We're going to tell you what to expect when the numbers hit the tape after the grounding of the 737 MAX.